Hello, everyone, and welcome back to another episode. I'm your host and millennial investor, and I wanted to let y'all know that today is the day. Today is the last time that you guys will be seeing me without a camera and without a good, halfway decent microphone. The next time that you guys will be tuning into my channel, you will be seeing a full update. I have a brand new camera that just arrived at my house. I'll be setting all that up throughout the course of this week, so give me a couple days, and sometime within the next week or so, you're going to be seeing a video that finally shows my face and has some good graphics and some good features and will make it a lot more enjoyable to watch. So this is going to be the last update that you'll see that doesn't show my face, but we're going to give the monthly update. So let's go ahead and give this monthly update for my annual dividend income, my monthly dividend income, portfolio value, and monthly YouTube income. So let's go ahead and take a mental picture, and I'll give you the update here in 3, 2, 1. And there you go. Here's the update for the month of June. Once again, record annual dividend income, just like we see every single month, with more deposits, more referrals, more dividends that we receive. And then monthly dividend income hit a new all-time high of $48.37. And so let's go ahead and scroll down here, and I'll go ahead and give you guys a quick update for my other two graphs. Once again, go ahead and take a mental picture here, and I'll give you an update in 3, 2, 1. And there you go. There's the update for portfolio value and monthly YouTube income. The monthly YouTube income was very low compared to previous months, and that's mostly because I didn't post nearly as much. And like I said, next video, get ready for the next one. It's going to look a lot different on this channel. And then the portfolio value did uptrend as well, hitting about $14,000. And these are my 5 investing goals for 2021 if you haven't seen them before, and my 2021 stock market prediction. If you haven't seen M1 Finance before, if you haven't seen me, my name is Jordan. I'm a millennial investor. And right now we're having a promotion. If you get signed up with M1 Finance, you can get $30 just for getting started. We've had 114 people sign up so far, so go ahead and be number 115. So go ahead and be number 115, 115, and you can get $30 just for doing so. But with that, let's go ahead and jump to my activity feed here, and let's take a look at the dividends that we received for the month of June. If we go right here, if it'll let me click the dang thing, let me scroll down. You can see for the month of June, we received, let's see, $1.06 from Visa, $6 Southern Company, $4.17 from Johnson & Johnson, $4.81 from 3M, $2.93 from McDonald's, Realty Income, $3.70. Now, Whirlpool, for some reason, is split into two, so it's actually $1.51. $3.46 from Home Depot, $1.09 from Waste Management, $5.28 from Lockheed Martin, $9.48 from Broadcom, and $4.83 from Pepsi, totaling almost $50, $48.37 to be exact. And I'm so excited because that means next quarter, 3 months from now, when we get to, let's see, July, August, September, the month of September, it is very likely that we will be breaking $50 in passive income for the first time ever, and I'm super excited about that. And we're already getting a good start here for the next month. But let's go ahead and jump into my portfolio, and let's go ahead and start with my number one holding. And my number one holding is Broadcom. Broadcom currently makes up 9% of my portfolio, up 69% on a time-weighted return, or excuse me, on a money-weighted return, or $303 worth of total returns with earned dividends and market gain. I love this company because it has it all. It has yield, it has growth, it has share price appreciation. This company is one that I love owning, and I'm so proud to own because they are taking advantage of any and everything tech. They're a hardware company. They're a software company. They have big ties with Apple. They own Norton Antivirus. This company is one that I really love to own, and they have awesome M&A activity, and it's one that I really like to own because they are not only very profitable, but they're a company that, while many of these other giants that you'll see, while they're very profitable, they don't have a lot of revenue growth. That's not the case with Broadcom. This is a company that is on average still growing its revenues 7, 8, 9% every year while having massive profitability for both their hardware and their software solutions. So Broadcom, one of my favorites. It's my largest holding for a reason, and it will continue to be so for a long time. Realty Income and WP Carey are both tied for 8%, my second and third largest holdings, and both of these companies are incredible real estate investment trusts. Very high yielders. They make a lot of dividend income in the portfolio, and if you notice on the left column right here, they're actually number 1 and number 2 for the most dividend income because this list is sorted from highest to lowest in terms of dollars amount, not in the weighting of my portfolio. So while WP Carey and Realty Income are number 2 and number 3 as far as weighting, dollars invested, dollars paid out in terms of dividends, they're number 1, number 2, and almost $60 a year now as of last week in WP Carey just from that one holding alone. That's $5 a month just from that one company. I know that the next payout that I should be getting in about 2 weeks from now from WP Carey, I think is somewhere around $14, $15. So definitely a new record for me. And both these companies are triple net lease real estate investment trusts that have an awesome business model and will continue to remain profitable pretty much no matter what happens in the economy. And no matter what changes we really see as far as like technological advances or things like that, this is the type of company that it's going to be around for the long run pretty much no matter what. Visa is another company that I love. It's one of my favorites. One of the only companies in the portfolio that is focused on growth instead of dividend yield. Has a very low dividend yield of about 0.5%, but it does have incredible dividend growth, raising at least 10% pretty much every single year. Most years are far more than that. Not only that, the share price have had massive returns over the last decade, and that's because this company does arguably the most share buybacks of anybody on earth. I think other than Apple and maybe Microsoft, I think Visa does more share buybacks than anybody else on the planet, if I'm not mistaken. I could be wrong about that, but regardless, Visa is one that is growing because people are switching to debit cards, credit cards, online and mobile payments, and they're constantly buying out other businesses just like they did the other day as well, and they continue to remain massively profitable. Lockheed Martin has a monopoly on the defense sector. Almost every product that's produced by the Air Force, you're looking at them, these guys produce them. They have awesome contracts with the government that are in the billions of dollars. Their backlog is hundreds of billions of dollars. This company continues to have great dividend growth, share price growth. They do it all. Lockheed Martin is one that doesn't really follow along with the rest of the economy like 90% of other stocks does. It really kind of goes to the beat of its own drum, and it's one that I love holding, and it's one of my largest positions. Home Depot is one that I like as well. Has a long track record of returning great dividends and capital appreciation to shareholders, and that's why you see charts like this with Home Depot. 178% money-weighted return over the last 5 years. And that's because this company has continued to raise dividend 10% plus every single year, including this year in 2021. And this company also has an incredible business that is thriving right now throughout the pandemic. Prices are going up, people are building and buying homes like crazy, and Home Depot's taking advantage of it. Kimberly-Clark. If you've ever wiped your butt before, then you probably use Kimberly-Clark. They're the ones that sell all paper products pretty much that you'll find at Walmart. It's either them or Procter & Gamble almost every single time. Paper towels, toilet paper, Kleenex, diaper products. These are the type of products that Kimberly-Clark sells, and they do it massively profitable. The way that this company operates is that they pretty much have long-standing brands that you know and love like Huggies, Cottonelle, Kleenex, things like that, and they continue to sell those brands and also come out with new products in other categories and opening and emerging markets as well. As they do that, they continue to pay out massive dividends and buybacks to shareholders, and this is just one that is just going to be an easy, boring stock. They sell boring paper products, and a lot of people aren't going to get excited about that. Not a lot going to change, but basically the way I look at it, if people are still going to wipe their butt next year and 5 years from now, then Kimberly-Clark is going to benefit from it. Johnson & Johnson is one that's 5% of my holdings as well. Johnson & Johnson is the only healthcare company that I own, and this is like holding almost like a healthcare ETF or a healthcare mutual fund because they're so diversified between medical devices and pharmaceuticals and all different types of medical and healthcare products that this company just has its foot in the door with any and everything that involves health. This company is almost a $500 billion company for a reason because for decades and decades, pretty much a century, okay? For almost a century straight, this company has seen nothing but straight success. They constantly are acquiring other businesses. They're constantly reinventing new ways to generate new earnings, not just old existing earnings, but new ones as well. And that's why Johnson & Johnson is one of my favorite, and it's only one of 2 companies on planet Earth that are a large cap corporation that has a AAA credit rating, which is higher than that of the government's. 3M produces 60,000 different products, all diversified in different categories, different spaces. And when you have that many products in that different categories, it pretty much the way I look at it is that if the economy is going to grow long term, then 3M is going to go with it. They're in so many different categories, so many different spaces that it's hard to even get a gauge on what exactly they do. But long term, they have a track record of being very profitable. And while most conglomerates don't succeed very often, 3M is one of the few exceptions. There's really only 2 conglomerates that I really like in the stock market, or really 3 now I think about it. One of them's Berkshire Hathaway. Obviously, you got to talk about that. Berkshire Hathaway is arguably one of the greatest companies on earth. You can't argue with that. Another one is Honeywell, one that I've owned in the portfolio. A little bit of a new kid on the block, growing pretty massively. And another one that I like is 3M, and it's one of my largest holdings. 3M is going to continue to be one of my largest holdings because I love the profitability, I love the business model, and they're so established that it's really hard to find a scenario where this company goes bankrupt. Like I said, with 60,000 products, they sell so many things that guess what? If half of them aren't selling as good as they expected, well, that means that they still have 30,000 different products that are selling quite nicely. So 3M, one that I'll continue to hold in the portfolio. Let's see, next up we have Pepsi. Pepsi is one of my favorites. As a consumer, as an investor, I just freaking love Pepsi. But they have so many drink and snack brands that I absolutely love that I could just never imagine living without. Between Tropicana and Frito-Lays and Doritos, Fritos, Aunt Jemima pancake syrup, Pepsi, of course, Mountain Dew, Aquafina, Propel, Mug Root Beer. I mean, you name it, this company, it has it all. And that doesn't even count all the ones that I didn't name. There's so many others that it's just kind of ridiculous, like Frito-Lay and all those other brands that pretty much the way I look at it is that if you believe next year people are still going to need to drink beverages and next year people are still going to eat snacks, then Pepsi's going to be around. They have partnerships with new hyper-growth companies as well, like ones that I know and love, like Beyond Meat. They have a partnership with Beyond Meat and lots of other newer categories as well. And Pepsi is one that continues to come out with new brands, buy out other big brands as well, including last year's purchase of Rockstar, which should be on their balance sheet and on their income streams now. But Pepsi is one that I love as a consumer, as an investor, will always, until the day I die or until the day they go bankrupt, will likely be one of my holdings in my portfolio. JP Morgan Chase, my favorite financials company, they're really one of the only big banks that I see, in my opinion, adapting to the new fintech wave. There's so many companies like Square and PayPal and all these other big names that are constantly trying to take advantage of the new wave of fintech. And JP Morgan Chase is the only real competitor that I see that is making strides to fight off this fintech wave. They just announced another dividend raise from 90 cents up to $1, which is over another 10% raise. And while they paused raising that dividend for 1 year because of the pandemic, they never cut it, they never reduced, they never slashed their dividend. They continue to pay it just like normal. And now that the pandemic is gone and the government will allow it, they're going to begin raising dividends like crazy. I think that next year, the year after that, I think that this company is going to start raising dividends arguably close to 10% for the next couple of years, honestly, because they have so much cash from the pandemic that they didn't need to use for emergency, and now they're going to have to repay that back to shareholders. So whether it's dividends or it's buybacks, this company is going to be buying back and paying out dividends to shareholders in massive wave. And that's why you've noticed once we hit January and beyond, I think that's part of the reason why this company has done so good in share price, is not only because it's a bit of an inflation hedge, this company's been buying back its own stock. I'm not sure, but I think that JP Morgan is probably buying back quite a bit of its own stock, but it's also an attractive investment as well, so it doesn't really matter either way. But JP Morgan, one that I love. Procter & Gamble, very defensive. Any household basic products that you can think of, from deodorants to toiletries to feminine care products to shampoo and conditioners to smell good fragrances stuff, like you name it, like they produce it. Anything that you've probably, if you walk down the aisle of Walmart and it's any type of household product, it's a good chance that 10 to 20% of the products on the aisle, if not more than that, just any item in general, Procter & Gamble probably produces it. Because this is not just one brand of Procter & Gamble. They own so many brands. I mean, just look in the description down here, and that's just some of them. That's not even all of them. Always, Ambi Pure, Ariel, Bounty Paper Towels, Charmin, Crest, Dawn, Downy, Fairy, Febreze, Gain, Gillette, Head & Shoulders. The list goes on and on. This company has so many massive brands that it's almost no way that these companies don't remain profitable. And that's why I'm betting on Procter & Gamble. 3% of my portfolio is in Southern Company, boring utility stock. The way I look at it, people are going to pay for electricity. People are going to need natural gas to heat up their homes. Guess what? They're going to turn to Southern Company. This is a company that is very slow growing. They're only pretty much going to grow a couple percent a year because they're regulated by the government. But that's easy, steady, reliable dividend income, and it's a predictable business that is going to be very reliable in the future. It's not going to be a big winner. I won't make massive money on this company, but it will produce very slow and steady returns. So Southern Company, I own that one. Next up, we have McDonald's. McDonald's is a little bit of an interesting one because while people might be shifting away from fast food, it hasn't stopped McDonald's. McDonald's continues to be successful, and that's not just because of the fast food. That's because this company owns the real estate that it leases out to its franchisees. McDonald's will continue to be more profitable as they raise rents for their franchisees, and they over time, slowly but surely, come out with new partnerships like once again a Beyond Meat and other products targeted to more vegan and vegetarian and more healthy products as well. I think that regardless of whether or not this company really turns into more of a healthy option for consumers, I think that just from the properties that they own alone, being basically like a real estate company that also sells hamburgers and fries, I think that McDonald's is probably going to be around, and that's why it's one of the best performers in the portfolio. Next up, we have Coca-Cola. Coca-Cola has hit on hard times these last couple of years with flat revenues, but profitability is coming back. This company has stopped focusing on revenue growth temporarily, and they're focusing on one thing. They're focusing on bottom line profitability. The margins have gone up and revenue has gone down. And that's because they have quit a lot of the brands that are pretty much failures, that they're really losing money on or they're making little to nothing on in a lot of foreign and emerging markets. This company is going back to the basics. They're going to focus on profitability, boost up their financials, and they're going to come out with something big. They've already done that so far. They're coming out with Coca-Cola Coffee. They've rolled out AHA, their new sparkling water brand. They've done Topo Chico. But this company is going to turn around and become the new age Coca-Cola. I think the returns that we've seen over the last 5 and 10 years for Coca-Cola, the next 5 and 10 years are going to be much better. But regardless, it currently pays out over a 3% dividend yield. They already raised that dividend in 2020, back in March of this year, or 2021, or in 2021. I forgot. We're not in 2020 anymore. In early 2021, they raised it in March. And so Coca-Cola, I don't expect it once again to be a big winner, but I think it'll start to be a little bit of a comeback. I think the next 5 years will be a bit of a turnaround story for Coca-Cola, and I also think it'll start to get back to those new all-time highs. Altria. I did just increase my position in Altria. I have been buying more of it, and I will be making a video on it soon. But basically, the way I look at it, you're getting over a 7% yield, almost 8% yield for investing in a company that is very profitable. Does it have a lot of growth? No. Have they had the best position and the best business decisions over the last 5 years? Absolutely not. But they will be a turnaround story, in my opinion. They are turning things around, and this company already has a plan of targeting 80% payout ratio anyway. And so this company, regardless of the stock price, regardless of what the business is doing, it's already made to pay out just about all of its earnings to shareholders. It's almost like a REIT, okay? And so when this company is paying you almost 8% just to own it, there's a reason why this company, while it might be one of my smallest positions with only making up 4% of my portfolio, notice that while it's one of my smaller positions, it's my third largest payer, because this company pays out such high dividends that your risk for owning the stock, in my opinion, goes down massively because you're already guaranteed almost an 8% return if they're able to pay out that dividend, which I think they will be. They're projected to increase their profitability next year, their free cash flow, their earnings per share, and that makes that dividend more and more safe. And they're due for a dividend raise in the next month or two. So stay tuned for that. I think that not only will they maintain that dividend coming up next quarter, in the next month or two, I think they're going to raise it. So stay tuned for that. Caterpillar, one that also just raises dividend. We've had a lot of dividend raises lately. And Caterpillar did just raise that dividend. I believe it was it $1.11, I think, if I'm not mistaken, like a 7.5% raise. Anyway, Caterpillar is seeing a lot of growth and a lot of speculators betting on this company for the potential infrastructure bill. It's one that I've lowered my portfolio a lot. It is a great company. I haven't been buying too much. I pretty much just been holding the shares that I bought 6, 8, 10, 12 months ago and just holding it and seeing where it goes. Store Capital, the other real estate investment trust that I own, much like a WP Carey and a Store Capital, or a WP Carey and a Realty Income, Store Capital is one that's a little bit of a newer kid on the block, pays a good dividend, has an awesome business model, one that I like owning because I love owning real estate stocks that are very, very efficient, and Store Capital is one of them. NextEra Energy Partners, just for a bit of a diversification purposes, I own some NextEra Energy, has a fast-growing dividend that doesn't grow every year, but grows every quarter. We're looking at usually growing something like 15. I'm going to say it again. This company usually grows that dividend something like 10 to 15% a year. So the dividend grows massively and the share price returns have been pretty decent as well. It's a new age business that is focusing on renewable energy, and it's one that I think will be successful over the next decade. Whirlpool trades at such lower valuation that I just have to own it. The PE ratio on this company, as you can see over here, usually trades around a 10. It's dirt cheap. Is it the best business ever? No. Is it one that will likely ever be the largest position in my portfolio? I don't think so. But in the last year, this company has raised its dividend twice. Not once, but twice. And went from $1.20 up to $1.40. That's like, what is that? That's over a 15% raise. I can't do that math in my head. It's too late. I'm too tired. But this company has raised that dividend over 15% just in the last year. This company has also had great share price returns, and it trades at such dog cheap valuations. And guess what? If it ever does go lower, I'm just going to get a higher dividend payment. So Whirlpool produces boring things like washer and dryers, and dishwashers, and refrigerators, and lots of basic things like that. Whirlpool, it's one that a lot of people take for granted. It's one that a lot of people look over, but I think it's one that's worth being in my portfolio. Not the biggest position ever, but it's one that will be comfortable sleeping at night owning 2% of it. Waste management, also own 2% of it in my portfolio. One of the most defensive positions in my portfolio because people are always going to make trash. People's always going to want to clean it up. Not a lot of people want to clean up trash, and I'm one of them. But waste management will do it for you, and they will get paid to do it. And as they do that, they continue to buy out other trash companies, other smaller names, to become more dominant and more monopolized in their position. They continue to pay out shareholders in the form of dividends and share repurchases. And this is one of Bill Gates' largest positions. I believe, other than Berkshire Hathaway, I believe it is its largest position. And this company continues to see great returns for shareholders. And it's not ever going to be one of my largest positions because the dividend is quite small at about 1.5%. But if this company were to ever see a big downturn, like say at a time when the market is at all-time highs, if this company were to go down to say $100 or $90 a share, I would definitely be loading the boat on the stock because it would have a great dividend yield and it would still have a great fundamental business. And last but not least, we have Verizon. 2% of my portfolio, very boring, very stable stock. Not a whole lot happens with it. Basically, they provide cell phone services to customers, raise the dividend a small 2-3% every single year, and continue to provide service to customers while producing high profits for doing so. They only pay out about half of their earnings in the form of dividends while still having a 4% dividend yield. So this company only has a payout ratio that's about half. Last time I checked, I believe it was around 50-60%. So this company still has a lot of earnings power to improve financials, to roll out the way for 5G or other projects that they want to do, or maybe try to buy out another company. Who knows? But Verizon is one that the valuation's so dirt cheap and it's so profitable. The cash flows are massive. It's not a lot of growth. There's not a lot of growth story going on here, and it's a boring company, and I don't expect it to be one of my biggest earners. But Verizon, I gotta own it because I'm gonna earn a safe, stable 4+% dividend yield, and I'm going to get slow share price and dividend appreciation over time. So those are the 22 companies that I own and why I own them. Thank you guys for watching all the way to the end. Get $30 for getting signed up with them on finance, and get ready for the next video, guys. Stay tuned because you're about to see the big show. Whatever. But anyways, I'll catch you guys next time.